JPMorgan is one of the world's most powerful financial institutions, but behind the numbers lies a complex system of assets, risks, and strategies. Let's explore this in simple terms on the FinTalk channel.
Imagine signing your name to guarantee this highly complex bet on human panic, and knowing that specific bet doesn't actually expire until the year 2045.
Right, yeah. That's a long time.
It is. You're basically on the hook for decades of totally unpredictable global events. And, that is the kind of staggering reality that's just hiding in plain sight within the financial documents of the world's megabanks.
Oh, absolutely.
So today our mission in this deep dive is to sort of decode the raw architectural blueprints of one of the largest financial institutions on Earth. We are looking at the Form 10Q quarterly report. This was filed by JPMorgan Chase & Company for the first quarter of 2026, ending specifically on March 31st, 2026.
Yeah, and, calling it a blueprint really sets the perfect stage here because when you look at the raw source material, you aren't reading like a traditional narrative or even just a simple balance sheet. This filing is actually coded in a financial taxonomy called XBRL.
XBRL.
Right, which is this digital tagging language that makes literally every single number and concept machine readable. It just strips away the storytelling and leaves behind this incredibly dense map of, global financial anxiety and opportunity.
Oh, wow.
I mean, this document tracks everything from a standard auto loan down in Florida to those exotic volatility derivatives you just mentioned.
So it basically functions as a master inventory for them.
Exactly.
Like the bank categorizes every conceivable risk, asset, liability. They slice and dice the global economy into these microscopic buckets. But I feel like to truly grasp what this mega bank is actually holding, we first need to understand the mechanics of how they assign a dollar value to these things.
Yeah, and that valuation process is really the foundation of the entire 10Q.
Okay.
The bank operates on this framework that they call fair value measurements. And to keep things standardized, the filing rigidly splits every single asset into a valuation pyramid.
Right.
And it has 3 distinct levels of inputs. You've got level 1, level 2, and level 3.
Okay, let's unpack this a bit because the way they segregate these assets tells a huge story on its own.
It really does.
Level 1 seems to be the most transparent. Like, my read is that it's sort of like checking the price of a popular stock on your phone, right? Say Apple or Microsoft.
Sure.
The asset trades millions of times a day, the price is totally public, and there is zero debate about what it is worth at any given second.
You've got it perfectly. The technical definition is that level 1 relies on observable, unadjusted, real-time market data in, active markets.
Gotcha. So then you step down to level 2, and it feels a bit like pricing a used car based on the Kelley Blue Book.
Yeah, that's a good way to look at it.
Like, you might not have a buyer standing right in front of you with cash for your specific, 2018 Honda Civic, but enough similar Civics have sold recently that you can confidently estimate its market value using that comparable data.
That is a highly accurate analogy, actually. Level 2 relies on observable inputs other than those quoted real-time prices. So the bank might look at similar assets in active markets or identical assets in inactive markets.
Okay, that makes sense.
It requires a layer of mathematical interpolation, sure, but the underlying data is still firmly tethered to observable reality.
Right. But then, and this is where it gets wild, we get to the basement of the pyramid, which is level 3.
Oh, yes, level 3.
Looking through the tags in this filing, level 3 feels like trying to appraise a custom-built underground bunker in a neighborhood where no property has changed hands in 50 years.
Yes.
There's no active market. There are no comparable sales.
Yeah.
So how does a heavily regulated bank assign a value to these highly illiquid assets without just crossing the line into sheer guesswork?
Well, they avoid guesswork by engineering these incredibly intricate probability matrices.
Matrices.
Yeah. When there is no active market, which, by the way, happens quite frequently with bespoke derivatives or highly specialized mortgage-backed securities, the document reveals they use a valuation technique known as discounted cash flow.
Okay, right.
And regulators actually force them to disclose the microscopic variables that feed these models.
Which is fascinating because I noticed those variable tags. They list minimums, maximums, and weighted averages for data points like prepayment rates, default rates, loss severity, and discount rates.
Yeah, so think about the mechanics behind those tags. If the bank holds this complex bundle of loans with no active secondary market, they have to mathematically project the future behavior of those borrowers.
So they're modeling human behavior.
Exactly. A prepayment rate model attempts to calculate how many people will actually pay off their debt early.
Wait, I always find this so counterintuitive. Like paying a bill early is classified as a risk factor for the bank.
Oh, absolutely. It comes down to reinvestment risk. Let's say the bank issues a 30-year mortgage at 7% interest. They are counting on decades of that specific yield.
Right. They want that 7% forever.
Exactly.
Yeah.
But if the borrower prepays the loan after, say, 3 years, the bank gets their principal back, sure, but now they might have to reinvest that cash in a market where interest rates have dropped to 4%.
Oh, wow.
So they lose all that expected future value.
I see. So they model the probability of early payments, and then I assume they model the opposite extreme with the default rate.
Yeah, they have to model the absolute worst case scenario of borrowers just walking away entirely. But, a default isn't a total loss, which is why they also model loss severity.
Okay, loss severity. What is that exactly?
Well, if a borrower stops paying, the bank will eventually seize the collateral, right? Like a house or a commercial property.
Right.
The loss severity variable basically calculates how much of the original loan value will actually evaporate after all the legal fees, the foreclosure process, and the eventual sale of that asset.
Man, they really account for everything.
They try to. And finally, the discount rate adjusts all of those projected future cash flows back into today's dollars based on the perceived macroeconomic risk.
So they are essentially running thousands of alternate futures through an algorithm to decide what that financial bunker is worth today.
That really captures the essence of it, yeah. Level 3 is a mathematical translation of human behavior and economic uncertainty.
It's wild. Now, those probability matrices predicting default and prepayment, they don't just exist in a vacuum, right? They are fed by the actual behavior of millions of individual consumers.
Oh, heavily.
Which brings us to the next really fascinating layer of this document, the consumer snapshot. Because the 10Q provides a ridiculously granular breakdown of everyday loans and credit cards.
Yeah, the geographic and demographic tracking here is relentless. I mean, the filing breaks down residential real estate and auto loans state by state.
Right, I saw that.
They explicitly list concentrations in California, New York, Florida, Texas, Illinois, New Jersey, among others. They monitor regional economic headwinds very, very closely. But they also apply these really strict metrics to assess the financial health of the borrowers themselves.
Yeah, one metric that stood out immediately to me is how they divide borrowers using a very strict FICO score threshold.
Right.
Like the dividing line throughout this whole document is 660. The data is separated into refreshed FICO scores equal to or greater than 660 and then less than 660.
Yeah, so a score of 660 serves as this critical demarcation line in consumer credit reporting. It basically generally separates prime borrowers from subprime borrowers.
Okay, got it.
But a credit score only really tells the bank about your past payment behavior. To understand their actual exposure, they have to pair that FICO score with the loan-to-value ratio, or LTV.
Right, so the RTV is simply like how much you owe compared to what the car or the house is currently worth today. And they bucket these into very specific groups, like less than 80%, 80 to 100%, 101 to 125%, and greater than 125%.
And let me tell you, that final bucket is the one risk managers watch with intense scrutiny.
I mean, I would hope so. A loan to value greater than 125% means the borrower is deeply underwater.
Deeply.
Like someone owes $25,000 on a vehicle that they could only sell for maybe $10,000. The fact that the bank tracks that specific extreme indicates to me that they are highly attuned to the psychology of negative equity.
Oh, completely.
Yeah.
Because a borrower who is severely underwater faces a completely different set of psychological and financial pressures than a borrower with, built up equity.
Right, because they're stuck.
Precisely. If a medical emergency hits or they lose their job, the underwater borrower cannot just sell the asset to pay off the loan. They are trapped, which statistically makes them much more likely to default.
Wow. Now, while we are looking at this consumer data, I really want to bring up something that caught my eye in the credit card receivable section.
I'm sure.
Because buried in this massive sea of generic aggregate credit card debt, there is a distinct line item explicitly naming the Apple credit card portfolio.
Ah, yes.
It tracks the data as of December 30, 2025, and all the way through Q1 2026. And I have to push back a little on this bank's co-brand credit cards constantly, right?
They do, all the time.
There are United Airlines cards, Marriott cards, Amazon cards. Why does this one specific corporate partnership get isolated into its own unique concentration risk tag?
You are hitting on a fundamental shift in how modern banking ecosystems operate today.
Really? How so?
Well, when a bank partners with a technology giant like Apple, the resulting portfolio is no longer just a random, diversified sampling of American consumers.
Oh, I see.
It quickly morphs into this massive concentration of risk tied to a singular hardware ecosystem, a very specific demographic of users, and a deeply integrated reward structure.
So the scale and like the homogenization of that user base actually elevate the risk for the bank.
Yeah.
Like if something impacts the tech sector, or if the corporate agreement itself shifts, the bank takes a highly concentrated hit all at once, rather than just the normal dispersed risk of a standard credit card pool.
That is the core of it.
Yeah.
The regulators and the investors demand to know exactly how much exposure the bank has to that single corporate entity. It's just too big. It can no longer be blended into the aggregate data.
Wow. And when a consumer, whether they hold an Apple Card or just a standard auto loan, when they start struggling, the bank's categorizations of distress are basically surgical.
They are very precise.
Like they don't just toss a file into a folder labeled late and call it a day.
No. The taxonomy tracks the exact chronological decay of the loan.
The decay. I like that word for it.
Yeah. A borrower starts in current and less than 30 days past due. But if they miss a cycle, they slide into 30 to 89 days past due.
But the next category is what really interested me. It's 90 or more days past due and still accruing. That implies the borrower is 3 full months behind, yet the bank is still counting the interest being generated by that loan on their books as income.
They are. The phrase still accruing is a really crucial accounting mechanism here.
How does that work?
It means that while the borrower is severely delinquent, the bank's models, perhaps based on the borrower's history or maybe the value of the underlying collateral, suggest that the bank will eventually recover both the principal and the interest owed.
So they're holding out hope.
Essentially, yes, they haven't given up hope. But if that hope evaporates, the loan drops into the final stages, such as in process of active or suspended foreclosure.
Man, it is methodical, almost like a medical chart tracking a patient's decline.
That's a great comparison.
But all of this FICO and 30-day late terminology, that's strictly for everyday consumers. Because when we flip over to the commercial side of the balance sheet, the bank utilizes a completely different grading rubric.
Yeah, consumer metrics are completely irrelevant when you're evaluating multinational corporations or massive property developers. The commercial segment focuses on commercial and industrial loans, known as C&I and commercial real estate. And the document even tags specific real estate subsectors like multifamily apartments and wholesale real estate commercial lessors. Right, which covers the entities owning office towers and giant shopping malls.
Yeah. So the internal grading system they use for these commercial loans, it looks a bit like a corporate report card.
It does.
The highest grade in the taxonomy is pass, which aligns with an internal investment grade. Basically means the business is healthy. But the negative categories genuinely confused me at first.
Oh, really?
Yeah, they use the terms criticized performing and criticized non-accrual.
Ah, yes. Those industry terms offer a lot of insight into the mechanics of corporate risk assessment.
Because I really struggled with criticized performing. I mean, that sounds like a textbook oxymoron to me.
It does sound contradictory.
Right. If a corporate borrower is performing, meaning they're making every single monthly mortgage payment in full and on time, how can the bank categorize them as criticized?
So the distinction lies between temporal risk and structural risk.
Okay, unpack that.
Well, in consumer lending, risk is highly temporal. It's mostly defined by whether you paid your bill last month. But commercial lending looks at the structural, fundamental health of the underlying asset.
Okay, give me a real-world scenario of how that plays out.
Sure. Imagine a massive downtown office building. The developer holds a $50 million loan with the bank. Currently, the developer is making their monthly payment on time.
Okay, so the loan is legally performing.
Exactly. However, the bank's analysts note that the building is only 30% occupied because, say, all the major tech tenants did not renew their leases.
Oh, man.
Right. So the owner is only making the mortgage payments by slowly draining their emergency cash reserves.
I see. So the bank can see that the math simply doesn't add up long term. The reserves will eventually hit zero.
Precisely the issue. The bank recognizes the structural flaw before the default happens. So they proactively downgrade the internal grade to criticize performing. It serves as a warning beacon on the balance sheet. It basically says the borrower is fulfilling their contract today, but the underlying cash flow of the property cannot sustain the loan tomorrow.
That really puts the foresight of commercial grading into perspective. So logically then, criticized non-accrual is what happens when those cash reserves run dry.
Exactly. That is when the structural flaw becomes a realized default. The financial distress is so severe that the bank no longer expects to receive regular principal and interest.
They just pull the plug on the income expectation.
Yeah. Returning to our consumer discussion from a minute ago, this is the commercial equivalent of removing that still accruing status. The bank stops recognizing interest income from that loan entirely, and they move into pure damage control just to recover the base principal.
The sheer scale of tracking every single office building and consumer credit card it's impressive. But this 10Q doesn't stop at just, terrestrial loans.
No, it certainly doesn't.
It moves into the absolute stratosphere of high finance, detailing how the bank hedges against global volatility using this incredibly dense layer of derivatives.
Yeah, and the derivative exposure is categorized by the execution method. So you have over-the-counter derivatives, which are these bespoke, custom negotiated contracts between two specific institutions.
Right.
And then you have exchange-traded derivatives, which are standardized and bought on public exchanges alongside exchange-cleared contracts.
The specific instruments they are backing cover everything from interest rate contracts to foreign exchange and commodities. But I found two highly exotic tags that perfectly illustrate the scale we are talking about here.
Which ones?
The bank is listed as a guarantor for the Alerian MLP Index ETNs due January 28, 2044, and the Inverse VIX short-term futures ETNs due March 22, 2045.
Ah, yes. The duration and complexity of those instruments are really notable. Let's examine that inverse VIX ETN due in 2045.
Please do. But before we even get to the VIX part, what exactly is an ETN? Because I think most people listening are probably pretty familiar with an ETF, right? An exchange-traded fund.
Yes, very common.
How is an exchange-traded note different?
That is a vital distinction to make. An ETF actually holds the underlying assets, like a basket of stocks or actual physical gold in a vault. An ETN, an exchange-traded note, holds absolutely nothing.
Nothing.
Nothing. It is an unsecured debt obligation issued by a financial institution. The bank is essentially issuing a bond that promises to pay the investor a return based on the performance of a specific index.
Wait, so the bank's guarantee is everything. If the issuing bank fails, the ETN is just a worthless piece of paper, regardless of what the index actually did.
Exactly right. And in this specific case, the index they are promising to track is an inverse VIX.
Okay, the VIX.
Right. The VIX is Wall Street's fear gauge. It spikes when market volatility and panic increase. So an inverse VIX product is a structural bet against fear. It generates a return when the markets remain quiet and complacent.
But betting against volatility seems incredibly fragile. Like, if a sudden geopolitical shock hits, volatility explodes, and an inverse product could collapse in value almost instantly.
They are notoriously sensitive to sudden market shocks, yes.
And they are backing this until 2045.
Exactly. The fact that the bank is the guarantor for an unsecured debt note tied to human panic, and that note doesn't mature until 2045, well, it illustrates the vast, decades-long plumbing architecture they are responsible for maintaining.
That's crazy to think about. And it also proves that this document isn't just looking backward at what happened prior to March 31st.
No, not at all.
Because there is a specific section called Subsequent Events. And one tag indicates that on April 13th, 2026, which is nearly 2 weeks after the first quarter officially closed, there was a major conversion involving Visa shares.
Yes, the tag details a conversion from Visa Common Class B2 shares over to Class B3 and C shares.
So why are they legally obligated to include mid-April events in a Q1 filing?
Because a 10Q is designed to give investors a clear, accurate picture of the bank's current reality. If a material financial event occurs between the close of the quarter and the actual filing date with the SEC, omitting it would make the document totally misleading. The Visa share conversion likely altered the fair value of the bank's equity holdings.
So the balance sheet must reflect the present truth, even if the calendar quarter has already ended.
Exactly.
So, what does this all mean for you, the person listening to this deep dive? When you see headlines talking about systemic risk or economic headwinds, it can feel incredibly abstract.
You really can.
But a document like this, Form 10Q, is the actual physical machinery behind those headlines. This megabank has constructed a labeled mathematical bucket for every conceivable event.
From the smallest to the largest.
Yeah, from a borrower in Florida defaulting on a pickup truck, to a half-empty commercial tower in Chicago, to a sudden spike in global panic tracked by a derivative maturing in 2045. They are monitoring it, grading it, and running probability matrices against it constantly.
It truly is a profound achievement in risk management and financial engineering. They have built an architecture that is attempting to quantify the entirety of global economic behavior.
Well, thank you for helping untangle this massive XBRL taxonomy today. What initially looked like a wall of impenetrable jargon is actually a highly dynamic, living picture of the global economy, exactly as it stood in early 2026.
It was a really fascinating document to explore, but I want to leave you with one final thought to mull over.
Okay.
We talked extensively about level 3 assets and those complex discounted cash flow
Oh,
models.
it's the matrices.
Right. Those models assume rational behavior based on historical prepayment and default rates. They rely on past human behavior to predict the future.
Makes sense.
But what happens to the math when a true unpredictable black swan event occurs?
Oh, wow.
If sheer widespread human panic cannot be neatly tagged and categorized into a level 3 probability matrix, how protected is the balance sheet really?
That is an unsettling perspective on modern oversight. Because if human panic breaks the math, you have to wonder who is really in control of the building. Until next time, keep diving deep.